Hello, Dawn Santoriello here. When hot investments generate their own short-term gains, one of the biggest motivators for speculative investing remains to be hitting to most people. If you ask someone who buys and sells stocks with the goal of realizing short-term gains, why do they do it? They will probably say that it's to make money. Of course, making money is the goal of every investor. However, repeated analysis has shown that the consistent and reliable returns are most likely to come from holding a diverse portfolio over a long-term period. This is what you would do if you're serious about making money over an investing lifetime, correct? But buying an investment and seeing it go up, and it just gives the immediate thrill of winning. More than the good feeling of a monetary gain, it gives the deep psychological satisfaction of being in control. And let's face it, we all want to be in control. When it works, it feels like something like this. You are smart enough to identify a bargain. And plus, on top of that, you had the guts to go and put your money on it. And now you enjoy the feeling of being a winner. Psychologists, they have long known that this is what makes gambling so addictive. And conversely, this is why gamblers who are not winning will keep playing and playing until they can make that feeling of being a loser go away. And since the prices in the stock market, theoretically, they reflect all available and even speculated about information on an investment, it seems logical to think that, okay, significantly undervalued securities are rare. After all, by the time you've heard about the latest hot stock or fund, so is everybody else. But analysis have been noting that when an investment gets a reputation for being the next big thing, the influx of money from short-term investors can temporarily raise its current price in a sort of a self-fulfilling prophecy. The Wall Street Journal columnist Jason Zweig explains how this can happen to an exchange-traded fund. What happens is investors, they buy the fund in droves, pouring in hundreds of millions, even billions of dollars into ETFs. The ETF managers can take that cash and pump it into the stocks the funds already owned. And if those stocks are small and thinly traded, the funds owning will drive up their prices. This will raise the value of that ETF even further, and it attracts even more money, and repeating the cycle all over again. So Z gives the example of the AARK innovation, that ticker symbol ARKK. This actively managed disruptive innovation fund had nearly a quarter of its 1.6 billion assets in only 9 stocks. 9 stocks. As returns flared, new money just piled in, the underlying stocks just soared, and over the next 2 years, the fund's assets balloons to $25.5 billion. Then, performance faltered, the hot money fled, and ARK Innovation had lost an average of 27.9% annually over the past 3 years. On its way up, the fund made a lot of money, made people feel very smart, temporarily. But when the underlying stocks revert to more normal prices, many investors received an expensive and unpleasant education in the risk of speculation. The prudent investor understands that emotions, whether good or bad, always drive poor investing decisions. By contrast, the road to a successfully funded retirement is marked by diversification, discipline, a realistic view to market rates over the long term. So, if you need help on this topic or just wanted to have a check-in, feel free to reach me at www.dsfinancialstrategies and click on Book an Appointment with Me. Have a great day.